Hello, Business 630 Corporate Finance Online students. This is Professor Hassey beginning our week 2 introduction video to our topics this week, capital valuation. And by now, hopefully you're all getting settled into our infrastructure and our Blackboard platform. You've posted a little bio about yourself, and I appreciate all your bios. It was great getting to know everybody. You've selected companies of which we're going to begin working on next week. And at the same time, you're scheduling appointments with me over tonight, Tuesday, November 1st, and next Tuesday night of an individual 5 to 10 minute sit downs with your professor, me, just to make sure everybody's comfortable with the platform and what we're doing. I'm a little late with our video this week. It's Tuesday, but I will be putting another video together this Friday, talking about the second half of our course topics for this week. You have no graded work assessment this week. Your only graded work will be to meet me, set up an appointment and meet the professor. I have posted your grades for week 1 discussion forum, and you can see that in your Blackboard in your grade report on the very front page. And I'll show you that in just a minute. So again, no graded work this week. Next week, you will have your first case study. It will be doing a credit analysis of a company, and that'll be posted next Monday and due on Sunday, the 13th, not the 14th. That's a typo there, excuse me. Okay, so let's get going, but let's just take a quick look at our Blackboard. Okay, first of all, I should let you know I am not speaking from my office at my home in Claremont. I'm speaking from my office at the University of La Verne in the College of Business and Public Management building, right next to the Wilson Library here on the La Verne campus. I'm here today with a class, and I thought I'd get out this video today, give you a different look of my environment of where I am at in my office at the university. So again, you should be getting familiar with our course. In our course information file folder are all the important dates. As you can see, our discussion, week number 1 discussion post is now completed, and we get ready for next week, our case number 1, which will be about a credit analysis, and it'll be in a paper format, APA format. More on that next week. And then we go into our various Zoom and YouTube links, and as soon as I do a video, it's posted to that file folder. Also, it's posted to the individual weekly file folder as well, and also it's posted to our YouTube playlist for Business 630 for this fall session. Here's week 2. You'll see our agenda, which you saw at the beginning of our video, just highlighting the week's activities. Our learning assignments for this week, we're covering chapters 4 and 5. I have a couple of examples I will put to show you today or this video and on our Friday video. And your main graded post is to select and prepare, get ready for selecting a date and time for your professor meeting. Also, there's the spreadsheet file, which is lecture notes, so which I'll be showing you in just a few minutes in my lecture. And then some basically videos explaining stocks and bonds. We'll see one of those today. The chapter 4 and 5 PowerPoint explaining time value of money and bonds. Again, some of this might be a review for you. A lot of it that you've already studied in other finance or accounting classes. But again, it's very important for us to understand the time value of money and also the definitions of stocks and bonds. Speaking of the time value of money, let's take a quick video explaining what we mean by the time value of money. Let's see that.
So if you've taken any accounting courses or any basic finance courses, you've probably been exposed to something called the time value of money. So we hear this concept a lot, and it's something very important to the foundations of finance and to some degree accounting. So we want to talk about, well, what does this mean from a conceptual point of view? What is the concept here? What are we talking about when we say that money has a time value? So let's look at this through an example. So let's take an example here. Let's say that I offer you two options. Okay, now one of the options is going to be that I give you $100 cash today. $100 today. And then in the other option, we're going to say that I give you, let's change colors here again. Let's say I give you $100 1 year from now. 1 year from now. Now, let's just assume for a moment that when I say I'll give you the $100 1 year from now, that's certain. That's not something that I might not pay it or something like that. It's guaranteed. You either get $100 today or you get $100 1 year from now. But either way, there's no risk associated with it. You're going to get the $100. So let's look at these two options. Now, which would you prefer? Now, you might say, well, I just prefer the $100 today because I just want the money. I have something I'm already going to spend it on. But let's just forget about that for a moment. Let's assume that you don't necessarily have anything you want to buy, but you do want the $100. Well, you might think, well, I'm indifferent whether I get it today or whether it's 1 year from now. But let's think about this because the money has a time value. Now let's illustrate this. So let's look at a little timeline here. So here in this option, we're getting the $100 right here, which we'll call this, that's today, right here. This is today. And then over here, this is 1 year from now. 1 year. Now let's go down to our other option, and we'll have a little timeline. And again, we've got right here is today, and you're not getting anything today. There's nothing here because you're getting it 1 year from now. You're going to be handed right here $100. Now let's think about things here for a moment. So when we get the $100 here today, what can we do with that money? Well, you could go out and spend it or something, but let's just assume that you didn't spend it. Well, what else could you do? You could invest that money. Now, let's say that you invested in something and you ended up getting a 5% return. Let's say you took it to the bank and you got a 5% return on some kind of investment. Now, what's going to happen is that at the end of that year, you don't have $100 anymore. Well, what do you have? You're going to have 100 times 1.05, which is going to be, that's going to be $105. So we see that if you get the money today, if you get it sooner rather than later, there's a value to getting it earlier because it can be invested to earn a rate of return. And then at the end of the period, you end up having more money than what you started with. Now, when we look at the other option where you get $100 at the end of the year, you didn't have the option of investing it here because you didn't have the money. So when you get the money sooner rather than later, there's more value there because you can go ahead and invest the money and earn a return on it. So that's what we're talking about when people say that the time value of money. They're just basically saying that money is something that if you're looking at cash flows, cash flow today or cash flow in the future, a cash flow today, all else equal, the same amount is going to have more value because it can be invested for that return. So now you might be thinking, well, how does this have real world applications or what are we thinking about? But let's say we've got some project that the firm is thinking about. That project, you might say, okay, well, we're going to buy this machine and it would generate cash flows over a period of, let's say, 5 years. So you can look at these different years and you can go and say, okay, here's year 1, 2, 3, 4, 5. And you can say, okay, well, we estimate that in year 1, if we get this machine, we're gonna have $100 in cash flow. In year 2, 175. Year 3, 200. 300, and then let's say in the last year it generates 50. But what you can do is say, okay, well, now we know we're estimating these cash flows, but now what we want to do is we want to say, okay, well, like for example, here in year 5, that $50, we can't just add all these together and say, okay, well now we've got this sum and this is how much it's gonna generate from this. We have to take into account that $50 5 years from now is not worth the same as $50 today. So what we're going to do is account for this time value of money and TV, maybe not the best acronym I have there, but the time value of money. We're going to look at this and we're going to say, well, what if we can just go ahead and say we earn a 5% interest on all our investments? Then we can say, okay, let's figure out what that $50 5 years from now is worth in terms of today's dollars. And when we do that, what we're doing is called discounting cash flows. So we're discounting cash flows. So that 50 here, this is a cash flow in year 5. And what we're doing is we're saying, what's the rate of return we could have earned on money today? Let's say 5%, 7%, whatever it is. And then let's use that to go ahead and discount this number and say, so it's going to be something less than 50 because maybe it's 30 or 35 or whatever, depending on your discount rate, could have been invested today to get 55 years from now. So when we talk about discounting cash flows, what we're doing is we're using the time value of money concept and some other formulas that we're going to talk about in other videos to take future cash flows and figure out what are they worth today.
Okay, those are the basics of time value of money. In other words, we're looking at money in the future or today in the present. Here's an example. This is the spreadsheet in week number 2. This applies to our class, the strategy of corporate finance. Let's say we want to make an investment of $100,000 today. And we anticipate with our accounting skills to project $140,000 of cash flow being received over the depreciable life of this asset, 10 years. As all of you remember from your business finance days, the depreciable life of an asset sets the time that an asset can prove valuable. Because why? You get a depreciable expense tax deduction and a depreciable expense of non-cash as part of your investment. So 10 years is the depreciable life. That's how long we rank or do analysis of this particular investment, or as this individual or professor said in the last video, project. So 140,000. Well, what is that $140,000 value today? What is the net present value of that 140,000 today when we're making the investment of $100,000? Okay. Well, let's say this company got this money, this $100,000, by getting a bank loan. The bank loan was 6%. That's their cost of capital. It's costing them 6% to get this 100,000. So that's your discount rate. That's your hurdle rate. That's your weighted average cost of capital. So what we're going to do now is do an analysis by taking these cash flows from year 1 through year 10 and discount them back to today's value at a discount rate of 6%. So we use, thank God for spreadsheets, we go to our formulas function in our spreadsheet, go to insert function, and we look for the financial application category of these formulas, and we function net present value, NPV. There it is right there, NPV, and hit OK. So now we're going to put in our cost of capital, our borrowing rate on this money, 6%. And then we're going to put in the values of the cash flow from years 1 through 10. So I'll just paint from year 1 through year 10, E7 to N7. And now what it's this function in my spreadsheet is going to take that 5,000, 5,000, all the way out to 20,000, 10 years from now, and discount it back at 6% to determine what is called the discounted cash flow. And there it is right there, $96,122.63. So that 140,000 of actual cash received over 10 years is really worth $1,000 when you discount it back at the cost of your money, 6%. Well, then if we compare that Okay, if we compare that to the cash flow or the investment of $100,000, our net present value is a loss of $3,877.37. In other words, we're losing money on this investment, even though it says, well, we're making 140,000. But if you're taking into account the cost of money, we're losing money. It's called negative return. Another way of looking at this is to determine the internal rate of return of this project. Again, another formula, function, formulas, financial, IRR. And many of you have probably used this before, internal rate of return. And now I paint, including year 0, the investment all the way out to year 10. So I include the investment year as well, and it gives me a percentage, 5.33%. Well, one of our investment principles that we talked about last week of finance is you want to earn a greater return than your hurdle rate, than your cost of capital. Well, look what's happening here. Our hurdle rate or cost of capital is 6%, and we're only earning 5.33% on our money over 10 years. That explains why we have negative NPV. We're not fulfilling and including all our costs. This is a very key function when it comes to time value of money in financial management and corporate finance. What is the relationship of the investment year to the years of cash flow generation off that project or investment? And is it profitable discounted back to your investment year? It's called net present value, internal rate of return analysis. And we'll be doing a lot of this in the coming weeks in this course. How do we look at an analysis? Let's do it another way. Let's say I'm thinking about making an investment of 100,000, and here's the cash flow, and my inflation rate currently is 6%. If I take that 6% inflation rate out to 10 years, is this 100,000 a viable investment? No, it isn't. With the inflation rate, I'm losing money. So the rate or the discount rate determines your profitability and return in an asset. It's the strategic goal of every CFO is to invest the assets of the company to exceed the cost of capital to get those investments, and to do the appropriate strategic decision-making of finding markets, finding assets, finding partners, finding cheap costs to make those assets more valuable. That's one of the key functions of a financial manager, CFO. The time value of money explains that. Now, in our video on Friday, we're going to talk about bond valuations. What's one of the ways that we can get this $100,000? We issue a bond. What's the difference between a bond and any other type of borrowing? It's really nice. In a bond, it's interest only. If you qualify